this week very choppy. We've had this sort of pattern of an initial sell-off, followed by a rally, a sell-off, followed by a rally, and week closes on both days. You can see from the sector performance, pretty much everything sold yesterday. Monday performance really negative for everything, with consumer cyclicals leading the way. Energy being a bit of a bright spot on the week and the day, showing a positive return. But again, consumer stocks, basic materials, consumer cyclicals, industrials all down on the week. On the month, consumer cyclical and tech up, as well as comms. Communication services have things like Google in there, and consumer cyclical will have things like Tesla. So some of the sector compositions are perhaps not as you might expect, because I suppose they're old kind of sector classifications. But you can, if you want to know what's within these sector buckets, you can always go to FinBiz and let me move that screen over there so I'm more looking at the camera, and see just what exactly is in there. But one of the reasons that you might be confused that communication services is at top, but that's because it contains things like Google and probably Apple. No surprise over the sort of 3-month, half-year, 1-year performance, with comms, consumer cyclical, tech, and financials all leading the way since the election. Basic materials and healthcare struggling, and on the year, big losers over the half year and the year have been the likes of basic materials, healthcare, real estate. Those are all just sectors of the economy that either impacted by higher interest rates, impacted by the continued slowdown in China and lack of any real stimulus, or perhaps impacted by the shock of RFK's appointment and what that might mean for the healthcare sector. But certainly an interesting pattern over the last 3 months, with a very clear demarcation between the winners and the losers, with the losers down 11 to 14% and the winners up 8 to 9%. So while market breadth is poor within the S&P, there is high dispersion among stocks. We also see that through the implied correlation we've looked at before. So a good 3 months for stock pickers. If you found the right things to be short and the right things to be long, you could have done particularly well the last 3 months. And I think that's probably going to be the pattern into next year. I think next year is probably, on the half year, going to look a bit more like, I would imagine if we're sitting here in June next year looking at what 6 months have done, it's going to look a bit more like this than it is going to look like that. Or that. I think it's going to be more of a stock pickers market where you have to find alpha. Yes, I do think US equities will be higher, but I think the real opportunities are finding the winners and losers in and among that. Have plenty of time to talk about that early next year. This is what I was hinting at when I said I think that an element of what has been going on is pension fund rebalancing. It often gets talked about. It often doesn't matter. But just this time around, if we look at Goldman's estimate down here from the trader, they estimate it's in the 87th percentile. See, it's not, it's 87th percentile. They don't have to rebalance. They can decide when they do it. They're not systematic funds in the sense that they're not kind of locked into a particular cycle. The assumption is that they rebalance, and that this idea of pension fund rebalancing is basically, if stocks have outperformed bonds significantly, then pension funds will sell stocks, buy bonds to rebalance their asset allocation. But that's in reality, that's not always how it works. Sometimes you will have your quarterly asset allocation meetings, and at those quarterly asset allocation meetings, you will decide, okay, this is our current benchmark weights. This is where we are versus the benchmark weights. And a simple decision might be, yeah, we'll rebalance everything back to benchmark. But equally, a lot changes over a quarter. A lot of these pension funds were probably underweight US equities And therefore, if they've got slightly overweight because of market movements, they may be happy with that. They may even decide they want to buy more. So it's not a simplistic mechanical thing. You hear a lot of people talking about month end, quarter end pension fund rebalancing. That means they will sell equities, buy bonds, or buy bonds, sell equities. It really isn't that simple. It's not that straightforward. But it does seem like on Friday and earlier this week, there was a bit of that type of price action because we saw equities go down. We saw bond yields go down. So bond yields down, it means prices up. So in an otherwise very illiquid market, I think the footprint of this kind of flow is more easily observed. A lot of the time, month end is just, it's just month end. It's not particularly less or more liquid than any other time of the month, but at the end of the year, month ends is a bit fuzzy. A lot of people would have taken last Friday as a more liquid day than today because today bond markets shut early today. So the month end rebalancing has probably been going on Friday, Monday, maybe a little bit today. It's not all on one day, but it's going on in a context of pretty low liquidity across the boards, and therefore I think it just had an outsized impact over the past few days. The other reason the markets have been a bit more choppy is the gamma profile is a lot more volatile than it normally is. It's a little bit lower, so you can see for a 1%, for a 2% move lower, we get into negative gamma. I wouldn't worry too much about a big move higher, but you can just, one of the reasons I think markets are struggling to get beyond that 6,000 level is this a big gamma pin up around there. We can see it better on this sort of heat map chart where we're looking at the top line for the current week. Extremely long gamma just at current spot levels, and then as we move up, you need to go up 1, 2, 3% before it gets short. So that very 13 billion of gamma at current levels just means that as the market goes up, dealers are selling it. As it goes down, dealers are buying it. So it just acts to compress price action around about here. That all drops off this week because we've got a big year-end expiry today, the 31st of December expiry. A whole bunch of this stuff will drop off. That's why you can see the gamma line below looks quite different. So this is, if you can't see the text, it's quite light. This is next week. So this is from the 31st of December to the 7th of January. There's a huge drop off in numbers. You go from 13 billion down to 177 million, and then it builds again into the end, into March. But again, it will build as people come in and do trades. But the point is, there's a lot rolling off today, and that will leave markets freer to move into next week, which may or may not be a good thing, depending on how which direction you want them to move in. We do have some potential impact of those systematic funds selling as well. They're particularly long equities at the moment. So this chart just shows you on a conditional basis for the CTAs. So remember, those guys just trade based on trend and vol. If we do get a small up market, they buy a little bit more. If it's down small, they probably sell more than they buy. Or if it's a big down move, they would be selling in the region of $40 billion. So not small numbers, but remember that buyback flow through November was in the region of $60 billion a day. So 40 billion length being sold into the market is not small, but equally it's not huge either. Albeit another point from the Goldman's trader that liquidity has dropped significantly. So what they call top of book depth. When we say top of book, we mean basically if you think of when you look at your option chain, you have bids and ask prices per strike. So you got a bid and you got an ask. Behind these bid and ask prices, going all the way out are slightly worse bids going this way, slightly worse asks going this way, and increasing liquidity and declining liquidity. So the majority of the liquidity is probably not at the best bid or ask. It's probably a little bit behind it. So if you have a really large order to fill, and you trade it clumsily, or you know you're just in a hurry, you just need to get it done at market. What will happen is you take out the best bid and ask, and then you plow through all of the offers below it, and you take out all of this liquidity, and you hope that basically you get your order filled before liquidity disappears, because if it doesn't, then you get this sort of air pocket moment where you literally you may hear it sometimes about taking out the bid stack. You've sold so much, you've literally taken out all of these resting orders, and then there's fresh air, and that's where you see those sort of dramatic sell-offs of markets where it trickles down, and it goes boom. You hit an air pocket, and it's because you've taken out all of the market depth. You've just sucked all the liquidity out immediately. There's no one else willing to sell to you momentarily, and therefore the price goes into free fall. So market depth, a deep liquid market is one that can absorb big price flows without any real volatility. A market that has minimal order depth in the order book is one where if you get a big trade, it can really push the market one way or another. So right now we're in a position where top of book depth is 35% lower than on average. So any big orders are likely to move the market. And I think that's just a little microcosm of that from yesterday. Don't normally look at such high frequency charts, but I thought yesterday was quite interesting because this is the SPY, and that's why there's a big gap here. But the futures actually started selling off yesterday around noon, so I expect there was some European pension funds doing a bit of rebalancing or a bit of tidying up ahead of the new year. So you got big order flow that came in. We can see it, actually you can see it better, a little bit better on one of these charts. Yeah. I don't have the futures chart there. But big order flow came in that just took out all of the bids all the way down here, collapsed the market very quickly. The same thing happened on Friday. We saw that 1.5% drop, and then we got down to this level, and everything sort of stabilized. This is about 40 minutes into the trading day. It starts here at about 3:30 European, and this is about maybe about an hour into the trading day. And from here on in, this is a very clear. This is why I've drawn, what I don't normally do, which is to draw a line on the trend. This was a very clear footprint of a TWAP or a VWAP. So someone who's just put in an order down here to say, I want to buy however many million S&P. I want to do a little slice every minute, or I want to do a little slice. I want to be constantly 20% of whatever the volume is. So you're just taking away buy until, and when you see that, and you see it, you don't perhaps normally see it quite so easily in the S&P because there's just so much other stuff going on. But because it wasn't a liquid market, I think you can see the footprint quite nicely. And I was watching this in real time, and I was just playing around with some zero DTE options just for the crack. I don't recommend you do it, but yeah, I think I bought some at 94s or something up here, and just bought them down here, made 200% return by here, but it was just making mass money, so it didn't really mean anything. But I was watching for this to break, and once this broke, then I closed the trade out, because once this stops going up like that, if we start to see this sort of thing, that means that buy order is gone. That trade is filled, he's finished doing whatever he needed to do, and we're back to this sort of unpredictable market. So sometimes, we talk about when to use when is it useful to use sort of 5-minute charts? I think it can be useful on the day when you're looking to put a trade on, and you just want to check for little things like this. Is there any very clear underlying trends on a 5-minute level that might indicate that somebody has got some business to do? And maybe I don't want to oppose that trend. I want to wait. You know, if I'm going to be bearish, I might feel quite bearish down here, but and therefore I might be looking to put on a bear call spread. But if I can see this kind of price action, I'm just going to wait until this kind of thing happens, because I can see right away there he stopped, whatever, or she stopped, whatever was happening here has changed. That short-term trend, which it lasted what about close on 2.5 hours. I mean that's a reasonable amount of time to do a TWAP, a VWAP. I mean, not a lot of liquidity. I mean, I expect this was not happening in SPY. I expect it was happening in the S&P futures. But there's no clear volume footprint to this. There is, if you look at the volume, there's nothing spectacular about this volume. It's just a very illiquid market. But I thought it was a really nice example that this is a clear buy order. The buy order is finished, and then the market just goes back to its kind of back and forth before we get a big sell on close flow. And that was a big, you see that big red spike in the volume bar? That was significant. So that was a whole bunch of orders lined up, sell on close. Whereas actually the day before, on Friday, just reading the Goldman traders notes, people were pre-positioning for potential hedge fund rebalance because the market had a whole bunch of buy on close orders lined up because people felt it was going to be a weak close, and they buy on the close, and indeed that is what we saw on Friday. We saw a little jump up into the close. So a lot of participants will leave these order types, which either they want to do their business immediately on the open or they want to do it on the close. That's like a MOC, market on close, or market on open, MOO order. And you can see all of these orders in advance. If you have oversight of the order book, you can see whether today it's got a big market on close sell imbalance or buy imbalance. Of course, it can change through the day, but just some days it's more significant than others. But I expect yesterday we had a big negative market on close sell flow, and that's what took markets down. But I just thought that was an interesting example. Of course, breadth. S&P breadth, positive and negative, was terrible yesterday, as it has been for some time. Mega caps just getting sold across Monday, across Friday, and probably across yesterday is another sign of rebalancing. Big market on open sell flow on these stocks that will have been heavily held. Bitcoin sold off with everything else and bounced, just reflecting how Bitcoin is now effectively a levered risk assets rather than anything else. US government yields actually fell on the day. Again, I think that's consistent with rebalance from pension funds selling equities, buying bonds, because as you buy bonds, remember yields moves inversely to price for bonds. So bond yields down means bond price up. And vice versa. More than happy to explain why if anyone is interested or anyone does not know, but it's probably not a topic for today. But if people are interested in fixed income mechanics and the nuts and bolts of the fixed income market, more than happy to do a session on that one day. But a lot of people are not, I know. Staying on the topic of bonds, where we are with the Fed meeting. We've got one in January, remember. It comes hot on the heels of December. We don't normally have back-to-back month-on-month meetings. As you can see, there's normally a gap. We go March, May, June, then June, July is back-to-back, and then we go September, October, and then there's a gap to December. So they're not on a monthly basis, or they cluster a little bit. But yeah, January, we've got one, and the expectation for January, this is the expectation for March, so we're building in January as well. January is like 88% no cut, and I think that was very strongly telegraphed at Powell a couple of weeks ago now. So there's no expectation of rates being cut in January. Of course, that may change depending on how the economic data comes in through the month. And I know there's been some notes from Goldman's just hinting that the labour market is perhaps not as strong as people think it is. So we wait and see. We get payrolls quite early in the month in January, so that will be watched, and we'll have a bunch of Fed speak as well. Remember, they're out of their blackout periods, so markets will be listening to try and discern whether or not that hawkish tone is continuing. And we also get Fed minutes coming up next week or the week after. I can't remember which one it is, but pretty soon. Those Fed minutes are going to be super interesting, just given it was a meeting where markets were somewhat shocked by how hawkish participants were and the projections were. You can see that better in this chart. This is just looking ahead to the end of next year, so to the meeting on the 10th of December 2025. And you see the pattern here is, this is an area chart where the probability is that under the area under the line. But the main thing that you can see is that from earlier in the year, so back at the start of November, or even the middle of November, I must try and get a longer run chart of this, but I couldn't get one in time. But you see just around the Fed meeting, there's a big jump in the purple and somewhat more the green, commensurate decrease in the blue. And the blue is for a whole bunch of rate cuts, which at the start of the year, you know, this 325, 350 end of year point was actually seen as the median expectation. Now it's no one expects to see an extra 100 basis points of rate cuts next year. Really what we're pricing at the moment is more the purple and the green, which is basically between one cut and two cuts. So I think we're literally pricing about 39 basis points for the whole of next year. Remember, before the Fed on the 18th of September, we were pricing 125 basis points for the whole of next year. So it's a huge pullback in interest rate expectations, and that has hit markets like the Russell, but you know, the likes of the S&P and the Nasdaq, while it's from time to time leaned on them a little bit, they seem to have pushed through it and just assume, okay, the Fed are on hold. That means that if there is any disruption in the market, if financial stability is threatened, they can come in and do big emergency cuts. So I think that the glass is still half full for a lot of people as they look at the Fed, but that may change if we start to see more interest rate cuts priced out, or we start to see inflation moving higher. So this is the results of the survey that Brent did with his readership. I think they're quite interesting. We'll run through them quite quickly, and then we'll go to questions if there are any, because right now there are not. Yeah, so what percentage do you assign to each of the following Fed outcomes? So no surprise to see it clusters around unchanged up to 50 basis points of cuts, and then it really drops off significantly from there. It's interesting that around just 7.5% of people expect one Fed hike. If we'd looked at that in September, that would have been virtually zero. There's even 5% thinking there'll be two or more hikes. But you know, ignoring the outliers, the sort of opinion of most professional investors, I think, is that, you know, either we see unchanged or possibly 50 basis points, but nothing more than that, which means a much higher terminal rate. I think that the scenario where the Fed don't cut all of next year and then maybe the start of 2026 is a hike, I think is one that's probably underpriced at this point in time. This is the expectation for what they think currencies are going to do from best to worst. No surprise to see the US dollar ranked as the best performer somewhat interesting to see Canadian dollar as the worst, just given that it looks like Trudeau is going to go, and that may, I mean, but the reason that Canada is in here as the worst and Euro is coming in next is largely down to the tariff threat um, being quite high for both of those developed markets. But one imagines that should Trudeau gets pushed out, then his replacement may be a little bit more friendly towards Trump. Sure, if any of you are really interested in Canadian politics, I won't go into that. But yeah, the potential replacement for Trudeau, I think, is a bit more aligned with Trump's camp. So I think that may be a little bit overly bearish on CAD, but definitely Euro. I don't know if Tor's on the call. I don't think he is, but yeah, people thinking the NOK is going to be weak, but towards the strong end. Interesting to see Aussie dollar in as the third best performer. It's sold off significantly recently with China, so there's a bit of a disconnect there, given that they see the worst performer within emerging markets as China, and Aussie is the best performer within developed markets. So interesting one. Dig into that. I think it's also interesting that they see the best performer in emerging markets as Mexico. I think Mexico is a lot more exposed to tariff threat than Canada is at the moment, so maybe that's a fade. But as you can see, Poland sort of in the middle of the CE3, as we call them. Its markets are more bearish for Czech and Hungary than they are for Poland. But yeah, the most bearish is China, and that's a combination of tariffs and also just the fact that we think the Chinese, although they haven't presented us with it yet, at some point will unleash some sort of large loosening of policy and stimulus. They just have to, but no doubt they're keeping their powder dry until they find out just exactly what Trump is going to do on tariffs. This is the picture of where people expect yields to be, largely unchanged to slightly higher, albeit there's an interesting cluster of people that think they're going to be a lot higher. So I think that's the people that are worried about inflation next year. And that is definitely one of the big concerns for next year. I think as Trent Brent, he doesn't play for Liverpool. As Brent said, the buckets are probably wrong here. They probably actually need some more buckets up here above 6,300. I mean, he's quite bearish, and that I know that's why he put the distribution like this. But the likes of Merrill Lynch, Goldman Sachs, and the big investment banks will all be sort of pushing for S&P, closer to 7K next year than 6K. So I think it'll be interesting to repeat this with a better scale, but no surprise to see 65% of people expect S&P to be up next year. That is completely consistent. As he says, with every strategist, every survey, every positioning analysis, the idea, the Fed's not driving markets higher anymore by cutting rates, but they're there if they're needed. So this idea that the Fed have got you back, the Fed put, central bank put, people are still leaning on that. I think that's risky because I think one of the risks for next year is that inflation, interest rates higher, and that somewhat ties the Fed's hands in terms of they will not want to cut rates dramatically if inflation is ticking higher. And they are, despite what people think, they don't really care about what the equity market does as long as it's not disorderly. That is not in their mandate. As opposed to the Chinese, it is not in their mandate for equities to be higher. It is in their mandate for full employment and to keep inflation to target. And if they have to sacrifice full employment to prevent inflation spiraling, they will. So central banker is always laser focused on inflation. And I think the idea of the central bank having you back as an equity investor is a bit of recency bias. It just comes from the fact that over the last in the post-crisis era, and what I mean by post-crisis is post-2008, in that sort of 16-year, 15-year era, inflation has never been a problem, and therefore the Fed have always had the luxury, if you like, of throwing in 50 basis points, 100 basis points if they need to. They no longer have that luxury. We're back to the way it used to be before most people were in the market, and therefore I think you have to be a lot more circumspect about the view that the Fed are going to bail you out next year and going forward. Just may not be able to. They'll be able to bail you out of a recession of something like that, because that will come with decreasing inflation. But if it's a problem around trade wars, inflationary policy, that's why equities are selling off. Don't expect an interest rate cut. Bitcoin, again, maybe a more mixed survey here, reflecting sort of a less retail, a less less retail participation. Most people do think it's going to go up next year. So we've still got that, similar to S&P, I suppose, with the 65% up next year. But there's more of a tail, I guess, of those that think that actually, maybe Bitcoin is put in the highs for now, and it may come down again. Tariffs is the thing everybody is focused on, and I'll put this in the chat because it's a long article and I didn't have time to read it, but I think it's an excellent, for those of you that don't mind reading about economics, and I know a lot of people do, so some of you might find it quite dry and quite boring. But for those that don't, I think that's an excellent overview of just how tariffs could pan out. And yeah, this again, a mixed picture. This is the thing with early next year. It's very hard to get a read on a sort of probability score of what might happen, because 60% tariffs on China is not out of the question. It would be dramatic. 25% tariffs on Canada and Mexico is what's been threatened, but it would be a surprise if that's what he came out with, because why put everything on, go all in day one? That doesn't seem to make sense. I'm surprised that actually is 20%, more threats and tweets, but no actual tariffs. I think to be honest, I would score the 25% tariff in Canada and Mexico closer to 15 and this closer to 5. I think there's virtually no chance he's going to do nothing, just because we know he's very frustrated in 2016 that he couldn't get going on tariffs quickly. I think one way or another we'll get something announced. So I'm very surprised that is 20%. I'd agree this is the most likely. You just go with a 10% global tariff, 10% on everything, and then you threaten. You say, okay, well, if Canada and Mexico don't, do what we want them to, you're going to get 25. If China doesn't do what we want them to do, you're going to get 60. But everybody's in the naughty step day one. Everyone gets 10%, and your copybook is marked, shall we say. We'll call you parents in if you don't pull your trousers up, so to speak. I think agree this is the most likely. This is the most market positive for sure. I think this sort of 10% global tariff with scaling, this idea that tariffs right away, and if you don't comply, then every month those tariffs are going up. This is something that is floated in that note, that's one thing they may decide to do. Markets would be a little bit confused by that, because you'd see the headline tariffs, markets would sell off because all the computers would sell, and then you'd see, oh well, actually it's only 10%. That's not as bad as that's not as bad as this or this. Maybe this is the best outcome, only 10% on Canada and Mexico, but again, I think that's probably unlikely. But there's more threat, and there could be more to come. It could get much worse. So I think The most likely outcome is probably this one, but it's not easy to think about what the market will do in that most likely outcome. I imagine it's initially equities down, dollar down, but then it's probably equities recover quite quickly as they realize, we haven't had this sort of tail tariff events coming through, and that it's more of a negotiating tactic, shall we say, and that the countries will fall into line rather than suffer punitive tariffs. But we wait and see. I think that the sort of these 60% on China would be very market negative. I think 25% Canada, Mexico, and don't forget Europe will be in there, probably quite market negative. This global tariff of 10% and scaling in is going to confuse the market, but I think eventually equities will rally. Markets would absolutely love this, but I don't think it's going to happen. And 10% on Canada and Mexico, bad for those currencies, but again, I think that's probably market positive. So the things you need to watch out for are big tariffs on Canada and Mexico, big tariffs on China. The other three are probably initially lead to volatility, but markets probably rally post that. So at the margin, I think that we'll have volatility around, and we'll hear about all of this around the 20th. So we'll probably have volatility then. But unless he goes super bearish, we should get through that volatile period into February, get through the Fed in January, and then I think Q1 probably can be positive for equities. But January is just going to be a very tricky month. And again, I wouldn't be jumping into credit spreads at the start of January just because unless you think you can get in and out within 20 days, because the 20th of January is a big risk event. And it's just Brent's view on the currencies that Canada should bounce back against the dollar, but the short euro trade I think has played out for now. We talked about that last week. I think some people were asking about euro. I think the short euro trade has played out for now. May get another bounce post tariffs, but arguably I think euro potentially strengthens towards the end of January before ultimately going much lower as the impact of tariffs lands. Just a few screenshots of a few trades that we've lined up over the last few weeks. These were companies that we discovered going through FinViz and just looking at their the way they were trading. I think Annex is a data center or something. I don't even know what they are. Gilead, their life sciences, they look like they were an interesting pick within healthcare. And these look like an interesting, I think it was in an uptrend, but it wasn't overbought within tech. So they both worked out pretty well. They would have automatically taken profits by now. Gilead as well worked out quite well. Nike on the bearish side, one of these companies that are quite tariff exposed and probably have other issues, despite the fact they have a moat. Listened into a very amusing conversation where someone was being very patronizing to someone telling them about, if you don't understand what a moat is with a company, how can you trade equities? This nonsense idea. Anyway, the moat didn't hold Nike recently. Someone needs to put the finger in the hole. But yeah, bear call spreads on that worked quite well. Put ratio back spreads. This hedging trade that we talked about, a MicroStrategy, hasn't really worked. It just didn't fall enough. So this was the idea that if MicroStrategy collapses, if the price goes back to $200, $150, we can effectively get a free put option as long as we don't hold the trade too long. So we have to roll it. It's an April expiry. And you can see that if we just hang on in there, we're just going to lose relatively significant amounts. So I think this is possibly one might look to roll just roll the strikes further that way. Probably roll the maturity out 1 month and keep it on into next year, because I think there's always a chance that MicroStrategy disappoints. BP is one that looked at recently. It hasn't really done much, so BP is still a potential That's still a good potential bear call spread, I think, right here and now. See, I think just put that on last week, and it's got a reasonable profit to loss ratio, and that does the strike, so that's still live and 52 DTE, so we'd be fine for next week. I'd say stay away from credit spreads in January. I think that's largely because I think most people tend to go bullish on the credit spreads and already have bullish portfolios. But if you do have quite a bullish overall portfolio, whether that's long stocks or leaps or other things, then looking for bear call spreads and companies that don't seem to be doing too well, that wouldn't be a bad thing, I think, in January. Those big trades that we've looked at continue to work, just to do what they're supposed to do. VIX has been up and down. Even I thought it was interesting that even the January bull call spread that was on for over a month, and I would have recommended you roll weeks ago, has still only lost 1.4% of its return over that period, despite the fact that VIX, and this is the price performance. So this what I sort of at pains to sort of point out to people. These trades can just hold their premium for quite a long amount of time. They tend not like a put spread over this period would have just looked like this. They just lose premium over time, whereas the VIX trades, they tend to hold their value better, which means that if there is a spike, like a little one in November and a big one recently, either you just accept that works well in your portfolio to offset the mark to market, or you can take profits. But as you can see here, this trade that we put on for about 20 cents, it spiked up to 90 cents. So that was a 400% return, which is what we'd sort of modeled potentially happening if there was a sell-off. It was a very brief sell-off, so you would have had to be quick to take profit. That is often the case, or roll the trade. But yeah, just an illustration that trade works quite well, and